It is March and I'm back with my top stocks for the month. To give an update on last month's picks, the average stock pick that I did in the same My Top Stocks for the month of February was up 13.5% compared to 6.1% for the S&P 500. So pretty good month. We had a great month of earnings. A couple of companies did really well, including Celsius. And this month, I think a few of the same stocks are going to be really good buys, and I got a few additions to the list. Hey, my name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So the first one I want to go over today, and one of my biggest holdings, still a great buy on the market, is Spotify. And the reason is we heard from Spotify that their financial results just continue getting better and better. Total monthly active users up 23% from a year ago to 602 million. Spotify could be a billion user platform within 3 or 4 years. I think that's really easily within reach for them. Premium financial revenue was up 17% to $3.2 billion. Ad-supported revenue jumped 12% to $500 million. And the big thing is operating expenses have been maintained at a pretty flat level, actually down slightly from a year ago. And that has really helped cash flow. That's bringing a lot of operating leverage to the business. That's when revenue goes up, but operating expenses don't go up as much as revenue. So if revenue can grow 15, 20% a year, and operating expenses stay flat, that's how you get a huge increase in net income and free cash flow. I think this is a company that can be doing $1 billion in free cash flow per quarter in the relatively near future, potentially in the next year or two. There's a lot that has to happen. They need to keep growing their user base. They need to add business to start contributing a lot more, but I think that's really going to start to see some momentum in 2024. We've seen things like artificial intelligence ad reads start to... That's a business that should have margins in excess of 40% once it matures a lot more. Right now, we're kind of bouncing near break even. Depending on the quarter, it'll be 5 or 10% gross margin. But advertising should be a real growth driver for Spotify, and I think that will start to kick in 2024. So a lot to like from this company, just hitting on all cylinders, and that's why I think this is one of the best stocks to own today. The next one's a little less popular, and that's going to be General Motors. And I think the reason to like General Motors right now is this is a legacy automaker that's generating a ton of cash, has a very stable business, and they're not getting involved too heavily in the very, very competitive electric vehicle market. What we've seen from results across the board in electric vehicles, there's simply not enough demand to eat up the supply that is increasing in that market. As a result, we're seeing margins drop across the board. Companies are losing more and more money. It's really only Tesla that is generating any sort of net income or positive free cash flow. And if the trends continue of their margins deteriorating, that may not be the case much longer. They're definitely not going to be growing production or revenue nearly as much as a lot of investors expected over the next few years. So where's the money going to go? Well, it's going to go to these legacy automakers who are building trucks and SUVs that people want to buy, charging very high prices for them, and they have less competition in those existing markets than they've had previously. Companies are not investing in building new trucks and SUVs for the ICE market. They're moving all that development work to the electric vehicle market. So I think that's going to mean that these legacy products are going to just cash flow even better year after year. Investors are getting GM for around 5 times earnings. The company's buying back stock at a really rapid rate. And still the ultimate upside that basically comes for free with the company is Cruise, their electric vehicle, their autonomous driving business. They've gone through a bunch of challenges over the last 6 months with Cruise, but this continues to be one of the leaders in autonomous driving. And if we do get to a world where there's autonomous driving fleets, I think there's going to be major network effects there. There's only going to be 1, 2, maybe 3 companies that are going to be able to build those kinds of fleets. GM has the capital to be able to build that out. Cruise has the technology. It's just a matter of maturing both of those things and getting to market before everybody else. But like I said, that's upside. You don't have to pay for it when a company is trading for 4, 5, 6 times earnings, which is typically where GM is trading for. Love the aggression that management has buying back stock. I think they're going to do that again this year. Could buy back 15 to 20% of the shares outstanding this year alone. So I still love General Motors and actually like its position as a legacy automaker as all of these upstarts fight each other for market share in electric vehicles. The third one is another legacy company, and that is Disney. Disney is proving to be one of the best legacy media companies and has better assets than most of its competitors. When you look at the streaming landscape, you have Netflix above everybody else, but then there's Disney. Disney has well over 100 million users for Disney Plus. They have a huge business in Hulu and also ESPN Plus. We know now that ESPN is going to be going over the top in 2025. They're starting to have more distribution from a streaming perspective with their sports streaming partnership with Fox and Warner Brothers Discovery. And at the core, you have a very, very profitable parks business. This parks business is really what investors should be thinking about as the safety net for Disney. Even if the streaming business continues to lose money, which I don't think it will too much longer, but even if it does, you have a ton of cash coming from the parks business. I think of this business like a waterfall. You have the studios that are creating content. That content goes to TV networks, to streaming, and then the content ends up at places like parks and in kids' toys and things like that. So a ton of ways to monetize the assets that they're creating. The financials have been the struggle over the last few years for Disney, but we're starting to see this kind of stabilize. The cord cutting is maybe not happening as the pace that it was during the pandemic. We're starting to see costs come more in line with revenue for the streaming business. That revenue is going up as Disney raises prices. Even as it's raising prices, it's also adding subscribers. So we're going to have a business that's growing revenue and keeping operating costs either flat or falling on a year-over-year basis. And I think as that hits, we're going to start to see streaming be a very profitable business. Disney has differentiated content, unlike most of its competitors. And the real upside is if they figure out the ESPN over-the-top strategy and the content that's going to go on there. Because if that becomes the go-to streaming sports app where you can charge $40, $50 a month just for access to all kinds of different sports, that's going to be an extremely valuable place to be for Disney. They already have a phenomenal position as the streaming go-to for families with the Disney Plus app. So you add that with Hulu and ESPN, I think that's a great position for Disney to be in. And we're just starting to see that momentum start to build. Love the revenue growth in streaming. Love the profitability improvements. And I think all of that will just continue over the next couple of years for Disney. Very well positioned for the future of streaming. And we're seeing that with some of the weakness at some of their rivals like NBC and Paramount, which are just kind of in no man's land from a streaming perspective. So Disney, much better position than it was a year ago. Investors are starting to realize that, but I still think there's a lot of potential for the stock. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The fourth stock is MGM Resorts. This is another one that I have covered multiple times on this channel. So if you want more detail, I'll put some links in the show notes. But the general story here is that the gaming market is now a massive cash flow business. All of the billions of dollars that were invested in casinos were primarily invested in the 1990s and 2000s. That's what MGM primarily owns, along with the casinos that were built in Macau. They own over a 50% stake in MGM China, which is really just starting to recover. So you have a supply constrained environment, and now demand is really starting to go up. And I think there's a number of reasons for that. One, people had more discretionary income coming out of the pandemic. But two, you have this major trend moving towards work from home, from more flexible work environments. Well, if you're working from home and you're not seeing your coworkers on a day-to-day basis, a lot of companies are choosing to meet up in entertainment hubs. So you get together 2, 3, 4 times a year. And where are you going to do that? Well, Las Vegas is a natural place to do that. It's always been a convention hub. They have the hotel rooms. They have the casinos. They have all the entertainment and restaurants. Just an easy place to fly in and out of if you're having a work meetup, meeting up with friends. And what we've seen is that gambling revenue, hotel revenue is overshooting where it was pre-pandemic. If you look at the 2019 numbers versus the 2023 gaming numbers, they're just up dramatically. This is the best environment we have ever seen for the gaming business. And it doesn't seem like it's going to be slowing down anytime soon. Maybe we will see it flatline, but Las Vegas as an entertainment hub is much better positioned than it was even just a few years ago. The new football stadium, the F1 race, there's just a lot to love about Las Vegas. On top of that, you have Macau, which is really just hitting where it was pre-pandemic, and I think could overshoot the way that Las Vegas did. And that would just be a cash flow machine for MGM Resorts. Add in the upside from a casino in Japan that will open around 2030. That could be the most profitable resort in the world when it opens up. And I think MGM Resorts is just really, really well positioned for the next few years just to be a cash flow machine. They're buying back stock. They're paying down debt, doing all the right things that you would want companies to do to be conservative with their capital allocation. And on the last conference call, management laid out, if you pull out their value in MGM China, which is a publicly traded company, and the value in BetMGM, which is their online casino business, the core business is really only trading for 4 or 5 times EBITDA, or the cash flow that's coming from these resorts. So that's a very good valuation. It's one of the reasons they've been aggressively buying back stock. And there's simply not a lot else for them to do as far as building new casinos. They're going to be putting money into the Japan casino, but the cash flow that they have coming from the business is probably going to be best allocated to buying back stock at this price. And I'm happy to let them do that given the valuation. And I think eventually when that valuation turns, there's going to be even more upside because there's simply going to be fewer shares outstanding. So that's why I love MGM Resorts right now. Next on the list is Zillow, another stock that I've covered pretty regularly on this channel. And really, this is one of those upside companies that could be many, many multiple times bigger as it matures in the housing market. And the way to think about this is the housing market has always been dominated by brokers, with buyers brokers and sellers brokers. That is starting to break, not only as the digital economy moves into the housing market, but also as that tie breaks because realtors were found guilty of collusion, of keeping realtors in the market, basically hiding homes from potential buyers that didn't have a buyer's agent. They were trying to protect each other, the buyer's agents and the seller's agents protecting each other. If you break that down, and now suddenly instead of paying 6% to sell a house, you can just put it on the internet. Where are you going to put it? Well, you're going to put it on Zillow. This is the number one place for people to go look for houses, number one place to look for mortgages, and now it's becoming the number one place to go look for places to rent. And I think if Zillow has a number one position in all three of those things, there are tailwinds over the next decade or two. This is a very, very long-term growth story. The housing market doesn't change quickly, but as we're looking for an aggregator to pull together all of the market demand and then eventually the supply comes with it, Zillow is the natural place to do that. Recent results showed a reasonable amount of strength, but given the weak housing market, there's not a ton of revenue growth or profitability, but they're taking market share in the home selling market, and they're growing tremendously in the rental market. That's where I really see this business starting to solidify its position. If it's the go-to for everything housing related a decade from now, this is going to be a stock that has the potential to grow 10x or more over that period of time. So I love Zillow's strategic positioning. We haven't seen the financial results of that positioning yet, but that's what I'm looking for over the next few years is momentum and then a growth loop starting to feed back on itself as it gains more market share in housing. Don't sleep on the fact that realtors are going to be in a much weaker position a decade from now than they are today because of these collusion findings in U.S. courts. The next stock on the list is Block, and this is one of those businesses that we have to look at the long-term trends. I've owned this stock for a very long time, but there's been a lot of ups and downs throughout the pandemic, in particular, as people thought that a lot of growth was going to continue forever in some of the payment markets, and that obviously wasn't the case. But if you look at their two business segments, they have a business side, the Square app, and then the Cash App side. And the advantage for Block over a lot of their competitors is they can tie those two things together and save costs for transactions, should be able to increase margins. So what you're going to want to see is a gross profit growth long-term, 22% year over year. That's just a phenomenal growth rate. The Square gross profit up 18%, maybe not the best growth rate, but in a world where a lot of companies are fighting over price for transaction volume, Square is holding its own given its kind of niche in the market. The Cash App continues to be a phenomenal business, up 25% year over year from a gross profit perspective to $1.88 billion. Adjusted operating income, look at this trend from negative $32 million a year ago all the way up to $185 million. Adjusted EBITDA is on the same trajectory, and net profit of $178 million. This is going to be volatile over time, which you can kind of see going back. But it does seem like Block is one of these companies that has started to realize that it needs to contain operating costs. And the hope would be you're going to see this net income number continue to be positive for the foreseeable future. I just wanted to highlight a couple of trends on the Cash App specifically. They go through this on the right. The Cash App borrow originations just growing like crazy, originating $3.6 billion in short-term loans in 2023. Cash App pay activities continuing to grow, now $2.5 billion in annualized gross payment volume. So that's a business that's growing tremendously just even on a month-over-month basis. And then they outline profitability by cohort. This is going to be when did people start using the Cash App. And what's really impressive is if you look at these older cohorts, they get more profitable over time. They start adopting more products. start paying for more services. And so that's exactly what you want to see, is you want to see more people coming in the top of the funnel, and then monetization of the existing users become better and better over time. So this is a really, really phenomenal trend for the Cash App specifically. Now, this is one company where my biggest hesitation is its CEO, Jack Dorsey. Dorsey is known for making acquisitions that aren't exactly the most financially sound. So capital allocation is going to be the biggest challenge for Block. The acquisition of Afterpay, I think, looking back, was absolutely crazy. The acquisition of Tidal still doesn't make any sense to me. And they're still spending a lot of work working on TBD, whatever the number is, the Bitcoin transaction project. We still don't even know a lot about what's going on there. So is Dorsey going to get lost in things that aren't really important to the core business? That's going to be the ultimate challenge for Block. But right now, I think the metrics are just too good to pass up. This is one of the most sticky companies in the payment space. It's really what makes a lot of small businesses run. Forward price to earnings multiple is under 24. Enterprise value to sales is only about 2 right now. So I think this is a pretty good value, and the real upside is if they're able to disintermediate some of the credit card transaction layers between the Square app and the Cash App. Are you able to bring enough cash into the Cash App and enough users into the Cash App to be able to allow them to just simply pay for things using the Cash App with Square readers? And that's really where you're going to start to see that fee go from around 3% to a much lower percentage. And Block could actually take a larger percentage of the fee instead of paying it to companies like Visa, MasterCard, their partner banks. Those are the companies that are taking up a massive amount of that transaction fee. But the good news for Block is they're generating a ton of their profit from subscription revenue now. So that's going to be sustainable for the foreseeable future. I just still really like where they're positioned. I think digital payments are going to be a growth engine long term, and all these companies are going to eventually figure out, though, they can't all lose money trying to chase after transaction volume. So Block very well positioned, not only because it has a Square app, but also because of that Cash App and the revenue opportunities you have there. The final stock is one that I'm probably going to be covering more on this channel going forward, and that is Sofi. Sofi is an online bank, and I think their biggest advantage over the competition is just simply that they're not spending a ton of money on physical overhead the way that a lot of banks are. One of the things I still think is crazy is I will drive around town and see a new bank being built on a regular basis. Why are we doing that when most of our banking is moving online? What are the people in these physical banks doing? I just don't understand it from a cost structure perspective. So one of the companies that's really leaned into that is Sofi. And you can see from their growth numbers here that they are just on a phenomenal growth tear in multiple pieces of their business. This is often a company that was seen as leaning on student loans and personal loans, so maybe a little bit riskier side of the financial services market. But you can see that their technology platform has grown. That's in the dark blue column here over the last few years. Financial services are starting to grow. They're getting into things like trading stocks, not just bank accounts, but adding in all kinds of products and services. And I've been really impressed with Sofi's management being able to grow the business at a reasonable rate and demand a solid rate of return. They're actually going to invest in the business based on how much money they have left over above and beyond a 30% EBITDA margin. That's the target that they have outlined. So if you have more EBITDA than that in a certain year, management said, hey, we'll spend that money on growing some of these financial services products or technology products. We will reinvest that money in the company in growth. And the results have been absolutely phenomenal. The number of members is growing like crazy, now 7.5 million. They're offering a bunch of these services to non-financial institutions. So that's going to be where they're going to be able to unlock some of their APIs and back-end solutions so that other companies can just integrate Sofi into what they're doing. I think there's just a lot of growth runway. This isn't just a bank. It's a digital bank that's moving into all the digital products and services that the modern consumer and investor expects, and making those services accessible to companies that don't want to build those things themselves. So I think there's a ton of tailwinds behind Sofi. But the massive differentiation is that this is a digital first institution. Doesn't have all of the overhead that goes with running a bank branch, with having trading floors. It can just lean into what it does best, which is the digital solutions behind the scenes. And it's hard to argue with their growth rates, not only their revenue growth, but the number of consumers that they have, how easy it is to interact with their products. And I think this is one of those things where, like I talked about cohorts with Block, those cohorts just get more and more valuable for SoFi. You may start with taking out a small loan, may move your direct deposit banking to them, may start investing with them, and over time, you're just generating more revenue for SoFi, whether that's taking out loans or investing. So many opportunities for growth for them. Looks very expensive. The stock is trading for over 130 times next year's earnings, but like I said, they're giving up earnings in the short term to be able to invest in growth, and I think eventually that pays off with much, much higher margins of profitability long term. So really like SoFi here. It's been beaten up over the last couple of years, started to make a bit of a comeback, and that's because their financial situation, their diversification is really starting to show itself. So those are the 7 stocks that I like for March. Like I said, February outperformed, so we'll see how things perform during March. I will be back in April with another group of stocks. Leave your comments and your favorite stock in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.